What happens when a major emerging economy's currency crosses a historic threshold at the same time global energy markets are under stress? And how far can that pressure spread if conditions persist? The Indian Rupee has moved beyond 94 against the US dollar for the first time, marking a decline of more than 10% since March 31, 2025, and placing it on track for its first full fiscal year drop in over a decade. This video examines what is driving this depreciation, what could change if the underlying crisis evolves, and how currency markets are reacting to a combination of geopolitical and macroeconomic forces. The immediate trigger for the rupee's decline is linked to the ongoing conflict in the Middle East, which has disrupted energy supply chains and pushed oil prices higher. On Friday, the rupee fell to 94.6525 per dollar, down 0.6% on the day, and surpassing its previous record low of 93.98, reached earlier in the same week. Since the conflict began roughly a month earlier, the currency has weakened by about 4%. Over a longer horizon, the decline exceeds 10%, reflecting sustained pressure rather than a short-term fluctuation. This movement is significant when viewed against historical benchmarks. The last comparable fiscal year decline occurred in 2011-2012, when the rupee fell nearly 14% amid concerns about Eurozone debt and weaknesses in India's external sector. The current episode differs in its primary driver, which is not financial system stress, but a supply-side shock in energy markets. The Middle East conflict has curtailed key exports and driven up prices for crude oil and related products, with downstream effects on goods ranging from cooking gas to industrial plastics. The relationship between oil prices and the rupee is structural. India imports a large share of its energy requirements, making its current account balance sensitive to changes in global oil prices. As Brent Crude rose by more than 5% to exceed $107 per barrel, the cost of imports increased, widening the trade deficit. This creates additional demand for foreign currency, particularly US dollars, putting downward pressure on the rupee. At the same time, higher energy costs contribute to inflation, complicating monetary policy decisions. Financial markets have reflected these pressures across multiple asset classes. India's benchmark equity index, the Nifty 50, declined by 1.5% on the same day the rupee hit its record low. Meanwhile, the yield on the 10-year government bond rose by as much as 9 basis points to 6.96%, the highest level since August 2024. Rising bond yields indicate that investors are demanding higher returns to compensate for increased risk, including inflation and fiscal pressures. This combination of currency depreciation, equity market decline, and rising yields points to a broad-based adjustment in investor expectations. The global context reinforces these trends. The conflict has contributed to a wider risk-off environment, with equities declining and bond yields rising in multiple markets. Investors are reassessing growth prospects, inflation trajectories, and fiscal sustainability across economies. In this environment, emerging market currencies, such as the rupee, are particularly vulnerable due to their reliance on external capital flows and exposure to commodity price fluctuations. Policy responses are also evolving. Analysts expect that the Reserve Bank of India may need to adjust its approach over the coming months. Some forecasts suggest the possibility of interest rate increases within the next year as a way to contain inflation and stabilize the currency. However, higher interest rates can also slow economic growth, creating a trade-off that policymakers must manage carefully. At the same time, there are indications that the central bank is moderating its interventions in the foreign exchange market, allowing the rupee to depreciate gradually while focusing on keeping government bond yields below key thresholds such as 7%. External signals have added to market uncertainty. U.S. President Donald Trump's decision to extend a deadline related to potential military action against Iranian infrastructure provided limited reassurance to investors. Reports that additional ground forces were being considered contributed to ongoing volatility, as markets attempt to assess the likelihood and potential scale of further escalation. These geopolitical developments are directly influencing financial conditions by shaping expectations about energy supply and global stability. If the conflict intensifies and energy prices continue to rise, one possible outcome is further depreciation of the rupee, potentially toward levels such as 96 or even 98 per dollar, as projected by some financial institutions. In this scenario, higher import costs would widen the current account deficit, while inflationary pressures could force tighter monetary policy. Economic growth forecasts could be revised downward, and financial markets would likely remain under pressure. If the situation stabilizes or de-escalates, a different trajectory becomes possible. Oil prices could retreat from current levels, reducing the cost of imports and easing pressure on the current account. This would support the rupee and potentially allow the central bank to maintain a more accommodative policy stance. Equity markets could recover as investor confidence improves, and bond yields might stabilize as inflation expectations decline. A third scenario involves prolonged uncertainty without clear resolution. In this case, the rupee could continue to weaken gradually, reflecting ongoing external pressures without a sharp shock. Policymakers would need to balance exchange rate stability with domestic economic objectives, using a combination of interest rate adjustments, liquidity management, and selective interventions. Markets would remain sensitive to incremental developments, with periodic volatility driven by news related to the conflict and global economic conditions. The broader implications of this situation extend beyond India. Currency movements in major emerging markets can influence global capital flows, trade patterns, and investment decisions. A sustained depreciation of the rupee could affect regional competitiveness, as well as the pricing of exports and imports across South Asia. At the same time, the link between geopolitical risk and financial markets underscores the interconnected nature of the global economy. The key factor to monitor is whether the underlying drivers of this pressure, particularly energy supply disruptions and geopolitical uncertainty, begin to ease or intensify. The trajectory of the rupee will depend on how these factors evolve, as well as on the policy responses implemented domestically. Stability in currency markets is closely tied to confidence in both economic fundamentals and the external environment, and shifts in either can have immediate and measurable effects.